Hi everyone, welcome back to the channel. Today, we're diving into an exciting topic, the role of behavioral finance in investing. If you want to understand why investors sometimes make irrational decisions and how to avoid common pitfalls, this video is for you. First, let's start with what behavioral finance actually is. Traditional finance assumes that investors are perfectly rational. They always make decisions that maximize their wealth. But in reality, we're human, and humans are influenced by emotions, biases, and social factors. Behavioral finance studies these psychological influences and how they affect financial decision-making. One key concept is cognitive biases. These are mental shortcuts or errors in thinking that can lead investors astray. For example, confirmation bias makes us look for information that supports our existing beliefs and ignore anything that contradicts them. This can cause investors to hold on to losing stocks because they believe they will bounce back, even when the data says otherwise. Another important bias is overconfidence. Many investors overestimate their knowledge or ability to predict the market, leading to excessive trading or risky bets. This behavior can hurt long-term returns because of high transaction costs and poor timing. Loss aversion is also a major factor. People tend to feel the pain of losses more intensely than the pleasure of gains. This can cause investors to sell winning investments too early to lock in gains, or hold on to losers for too long, hoping to break even. Behavioral finance also explains herd behavior, where investors follow the crowd rather than making independent decisions. This can create market bubbles and crashes as people buy into hype or panic sell during downturns. So, why does understanding behavioral finance matter for investing? By recognizing these biases, you can make better decisions. For example, you can create a disciplined investment plan, diversify your portfolio, and avoid emotional reactions to market fluctuations. In practice, many successful investors use behavioral finance principles. They stick to their strategies, avoid chasing trends, and focus on long-term goals rather than short-term noise. To sum up, behavioral finance helps us understand the human side of investing. It reveals why markets aren't always efficient, and why investors sometimes act irrationally. By being aware of these psychological factors, you can improve your investment decisions and increase your chances of financial success. Thanks for watching. If you enjoyed this video, please like, subscribe, and hit the notification bell for more investing insights. Drop a comment below if you have any questions or topics you want me to cover next. See you in the next